The number one fastest growing expense for the United States government is not our military, it's not Social Security or Medicare, and it's not infrastructure. The number one fastest growing expense for the United States government is our interest on our national debt. Take a look at this chart by the Congressional Budget Office. This orange line on the very bottom is the net interest expense by the government. The green line is the Medicaid expense. The purple line is the Medicare expense. The blue line is Social Security, and the red line is the discretionary, including the defense budget for the United States government. And what you'll see is if we go through the years, the fastest growing and the fastest accelerating line is none other than the net interest expense, and by around the year 2050 or so, that is when it is expected that the net interest expense is going to surpass not just Medicaid, not just Medicare, not just the discretionary defense budget, but also the entire growing Social Security budget. Now obviously there's implications to this, because if the government has to pay more money in interest, that means there's less money to pay for things like military and teachers and infrastructure and housing and everything else that the country needs. But the real question to understand now is, how did we get to this point and how is this going to affect you? Now there's two factors here that I want you to understand. One has to do with the amount of money that the government is spending, and the second is the interest rate that the government has to pay on the money that they borrow. Think of it this way. Let's assume that you wanted to go out and buy a $500,000 home, which is, let's just say, a lot of money, but you can get a very low mortgage rate, a 2% mortgage rate. Now, if you want to go out and buy this $500,000 home, your monthly payment might not seem like it's that big of a deal because you got such a great deal on the interest. But what happens now if you want to buy that same $500,000 home, but now you have to pay 10% on that mortgage? Now your monthly payment is going to be a whole lot higher. In this example, if you finance your $500,000 home with a 2% mortgage, you're going to be paying $1,500. But if you finance the same home with a 10% mortgage, now you're going to be paying over $3,500, a pretty big jump. But there's an exception with the housing market, because if you go out and buy a home in the United States, you can get a 30-year fixed rate mortgage. So if you buy this home with a 2% mortgage, you lock in the $1,500 a month monthly price, and then if mortgage rates go up to 10%, it doesn't really matter because you still only have to pay the $1,500 a month. However, that's not how it works with the United States government, because the United States government debt is not all a 30-year fixed rate mortgage. The United States government has debts that will readjust in 1 year, 2 years, 10 years, 20 years, and 30 years, which means the interest payments that the government has on the debts is going to vary depending on what interest rates are. And in addition to that, the government has been borrowing and spending a lot of money that they don't have. The government has one source of income, and this source of income is you, taxpayers, through tax dollars. This is the only way that the government generates money. So you go to work, you get paid, you make money, and then a piece of that paycheck is going to go to the government. You go out and buy a car, the government's going to collect some sales tax on that. You go and buy groceries, the government's going to collect sales tax on that. You buy a home, the government's going to collect property taxes on that. Now, when the United States government generates this money, this taxes, they can go out and save some of this money, or they can spend all of this money. And what we've been seeing happen for a long time now is that the United States government will take all of the tax revenue, spend it, and then some through the help of other money, through the help of debt, which is why we're seeing the largest national debt burden we've ever seen here in the United States. When the United States government spends more money than they bring in through taxes, this is called the national deficit, and the United States Treasury Office publishes what they think the national deficit will be. And like you can see here, at the time of me recording this video, it says that the federal government has spent $1.61 trillion more than it has collected in the fiscal year 2023, resulting in a national deficit. So when the government spends more money than what they bring in, this is called a national deficit. But the government doesn't always run a deficit. In fact, we used to have surpluses sometimes. Now, if you're wondering what is a surplus, let me just read it to you from the Treasury website. A surplus occurs when the government collects more money than it spends. The last surplus for the United States government was in 2001. And then, of course, you have a balanced budget, which is where the government spends exactly what they generate through taxes, which has never happened in the history of time ever. But what we've been seeing happen for the last 2+ decades is that the government makes money from taxes, and then they spend even more money through the help of debt. But the question is now, where do they get this debt from? Now, they can get this debt from people like you and me, regular people, taxpayers, investors, because now you can lend money through the government by buying treasuries. Now, it can also be other governments around the world. Countries such as China and Japan are big lenders to the United States, but they can also borrow money from the Federal Reserve Bank. And the reason why this is important to understand is because the Federal Reserve Bank is known as a central bank here in the United States. However, they're not federal, it says so on their website. They're not a reserve because they don't keep any cash reserves anywhere. And they're not actually a bank because you and I can't go there to deposit money. But what they do have the ability to control, the Federal Reserve Bank, is they have the ability to control monetary policy in the United States. That means they have the ability to influence interest rates, and they also have the ability to essentially print money out of thin air because they don't have any reserves. So when the United States government runs this $1.6 trillion national deficit like we're seeing happen, they might be able to get some of this money from other governments and from investors, but they're not going to be able to fulfill that entire national deficit, which is when they then call the Federal Reserve Bank and they say, hey, let's just say we need $1 trillion worth of money lent to us. Now the Federal Reserve Bank will print this money essentially out of thin air, give it to the United States government in the form of debt, and then the government has to pay this money back plus interest. Now this brings us kind of to where we are now, because what we've been seeing happen is that interest rates have risen at their fastest rates that we have seen since the early 1980s. The Federal Reserve Bank, who is our central bank here in the United States, has been jacking up interest rates very rapidly. Now the question is, what is the impact of that? We all see the impact to that in our daily lives, because if you go out and buy a mortgage rates are higher. You want to go out and buy a car, which I don't recommend you finance, you're going to pay higher interest rates. Credit card debts are more expensive. So now when you have any debt, these higher interest rates make it more expensive. But these higher interest rates will also play an impact on how much money now the government has to pay out in interest, because well, this government debt is not a 30-year fixed rate mortgage. Like what I said just a little bit ago, you have a bunch of different types of debt that the government issues. Some of it is very short term, like a month. Some of it is longer term, like 30 years. But most of it is somewhere in between, which means now the government has big chunks of debt that constantly is readjusting. Every 3 months, every 6 months, every 12 months, every 24 months, you see a big new chunk of debt that gets readjusted by the United States government. And now with interest rates rising so quickly, that means the payments that the government has to make are also rising quickly. And over the next 24 months, we have a huge chunk of national debt that is coming due, which means it's going to be readjusted, which means you can expect more and more payments by the government to be having to be paid out because the government has to pay back this money plus interest. It's just like when you go out and spend money at Gucci that you don't have. Now you got to pay this money back plus interest because you put it on your credit card. And so now you got to pay Amex plus the interest to buy that Gucci handbag that you couldn't afford in the first place. But what's the cost to this? How does this affect you? Because if the government's paying bigger bills, well, yeah, obviously maybe that means they got to spend more money, but how does that actually affect you? The first way that people get affected is less government benefits. Because eventually, if the government hits a point where they realize, okay, we can't keep spending so much money. We've been spending a whole bunch of money with a bunch of things, from infrastructure to Social Security to Medicare to funding wars overseas to doing all these other things. We can't keep affording this because, well, we can't keep affording the higher interest rates in addition to constantly increasing spending. So we need to cut back. And if the government has to cut back, that means less government benefits. That means maybe they spend less money on infrastructure. Maybe they spend less money on defense. Maybe they spend less money on hiring more teachers. We don't know where that cut is going to happen, but they will probably have to make cuts. And the reason why this is so important, if we tie in what's going on in the economy, is because remember, the government gets their money from taxes, and taxes are based off of people's incomes and business profits. If you enter a time where the economy is slowing, well, that means people's incomes fall because either people make less money or because people get laid off. If you have more people that are laid off, you have less people generating income, less taxes going to the government, and if businesses are making smaller profits, that also means less taxable income for the government, which means even less government benefits, which is why this is so important to understand. And by the way, if you do want to stay up to date on what's happening in the economy, That's why I created Market Briefs. Market Briefs is a free financial newsletter that I created to help you stay up to date on what's happening in things like the economy, the stock market, the housing market, the global economy, and crypto. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, the second way that this will also affect people is through what I like to call the hidden tax. Because anytime you print money, essentially out of thin air, the value of each individual dollar goes down. I mean, think of it this way. If we were living in a new hypothetical world and there's only $100 worth of money, $100 worth of wealth that's created, and this is distributed to the people that live there, people are living based off of this $100 worth of wealth. If you owned $1, you have 1% of the country's wealth, or this world's wealth. But now if the government created a new $100 and they distributed it, and now you had $2, you might feel richer in the beginning, but eventually you're going to realize you still only have 1% of the world's wealth, because now you have $2 out of 200 as opposed to $2 out of 100 that was there before. So if the government creates more money through the help of the central bank, that means each dollar has less buying power because it has less value. And that's what happens here. When the Federal Reserve Bank prints more money and they inject it into the economy here, whether by giving it to the government or by just giving it to the economy, more money gets created. If the government gets more money, now they spend this money in the economy somehow. It gets injected into the economy, but that means each individual dollar goes down, which in turn causes the price of things to go up. Not because each thing becomes more valuable, but because the currency, the value of the dollar being used to buy this thing, is going down. And so because of that, you have what I like to call the hidden tax, which is inflation. And now inflation hurts every consumer. And everybody's a consumer. Rich people, middle class people, poor people, every single person consumes, because when you want to go out and buy a car, or you want to go out and buy your groceries, or you want to go out and buy a vacation, it costs more dollars, which means you need more money to do that. However, inflation also disproportionately benefits the asset owners and the financially educated, because if now you are more financially educated, you own investments, well then inflation means you own a stock which is making more money because they're charging more dollars. And so now the asset owners benefit from inflation. Now, not everybody is an investor or an asset owner. In fact, you really only see a small percentage of the country that is asset owners, which means inflation disproportionately hurts the financially uneducated, the middle class, and the poor, and it disproportionately benefits the financially educated and the wealthy. You don't have to be wealthy to start benefiting from this, but it disproportionately benefits the wealthy because the wealthy people understand this. And so this is where now, when the government keeps spending more money than they have, this benefits the wealthy, and then, well, the person who pays the price is the middle class and the poor, because now to pay back all this taxes plus debt, to pay back all this interest, who does the government tax? They tax incomes. And who is paying the most income tax? Well, of course, wealthy people pay an income tax, but wealthy people don't just generate their money from incomes. They generate the majority of their wealth from their assets, which get tax breaks and lower tax rates. If you only earn your money from your salary, which is how the middle class and the poor earn their money, well, now you are going to be paying the highest tax rates, because income tax rates come at the highest rates that our tax code has to offer. Now, I'm telling you this as an attorney who is not your attorney, but our tax code has different buckets of incomes. You have the income that you get from your job, your salary, which comes at the highest tax rates, lowest tax deductions. And then you have the tax rates that come from your investments, your assets, which can either come with lower tax rates or higher tax deductions, which is where now, if you understand the system, you're going to want to stop just earning your money from a job. You're going to want to own these assets, but also now understanding that if the government now has to make a switch from spending to then saving, that's going to hurt this government benefits. And that means more and more of our tax dollars are going to be used to pay down our debt instead of giving things back to the citizens. And then you have the issue of, well, how are they going to get this money? because if the government now has to get more dollars, especially in a time where the economy is slowing, that could force the government to potentially increase taxes because they run into a situation where now they say, well, we have too many expenses and we need to keep spending money, but we need more money to do that, which means they need to generate more taxes, which would ultimately mean less spending ability for regular people because now more of your money is going to the government in the form of taxes. So this is why it's so important to understand what's going on with the national debt, the national deficit, and government spending because, well, all these things do indirectly affect people, whether it's in the form of government benefits, whether it's in the form of inflation, the hidden tax, or whether it's the form of taxes. When I first started learning about entrepreneurship and I first started seeing success in entrepreneurship, this is years ago now, I was so obsessed and I was so excited because I finally, for the first time, started making decent money. And if you want to quantify decent money, it was probably $200,000 or $300,000 a year as an entrepreneur from my own